Before we start this video, do like and subscribe to our channel and not miss on any updates.
Friends, today we are going to learn about credit derivatives. This is an interesting topic which has been added in the new syllabus, and this was a portion of it was there in FSCM, which was an elective subject that was there in SFM old. Now in AFM, this is a new topic that has been added. This is a very interesting topic. Now, those of you, most of you probably would have been kids when 2008 financial collapse actually happened, Lehman Brothers. You can check out, this was sometime in September and October of 2008 when the entire economic system was on the verge of collapse. Basically, you had Lehman Brothers, which was a large investment bank in US. They collapsed, they went bankrupt. And this was on the back of a lot of mortgage loans, basically housing loans. A crisis in those loans. So basically, there was a bunch of issues. We will discuss that as we move into this chapter. But credit derivatives as a concept at that particular point of time was, everybody would abuse credit derivatives. Okay, so in fact, there is also a saying somewhere in this. You will listen, or rather, I'd explain when Warren Buffett says that these are like basically weapons of mass destruction. Right. So credit derivatives, when used right properly, are definitely useful for anyone. However, if they are used purely for speculation activity, then they become a nightmare to handle. Okay, so let us understand exactly what credit derivatives are, then we'll get into all these aspects. It's a very interesting topic. I don't know how much they're going to ask in exam and all of that, but from a understanding perspective, this is a fantastic topic. Okay, while I have not worked on credit derivatives, let me be actually very clear. I have worked on almost every other thing that is there in the AFM material. Credit derivatives is something I have definitely not worked on. My knowledge is also what basically I have experienced, or I have read, I have studied or I have read, in my CFA program or in my, ISB, BA graduation, whatever I did, that knowledge is what I have. And of course, over a period of time I prepared, and even for these classes I prepared. But credit derivatives is something that is not so popular in India. It is largely a American and European invention, and it is very, very popular there. I'll tell you some fancy stories that we've heard also as we proceed further. Okay, first let us start off. What are credit derivatives? See, credit derivatives, they started sometime in 1996, and they were started to meet the needs of banking institutions to hedge the exposure of lending portfolios. So basically, all financial products are subject to two types of risk. One is the market risk, other one is credit risk. Market risk means when you have changes in interest rate, or when there is change in some basic price of the underlying, movement of stock market, interest rate, foreign exchange rate, some kind of a financial measure, there is a change, then the price of your, underlying, when I say underlying, your stock or bond or currency or something changes, gold, metal, commodity, anything, right? Second risk is credit risk, also known as counterparty or default risk. This risk involves non-fulfillment of an obligation by counterparty. So when you have a bond, and let's say the bond is not repaid on time, or bond is not serviced on time, or the interest is not paid, or the covenants are not met, or I've explained to you earlier also what are covenants. Covenants means basically certain conditions that have to be met by a bond. So whenever there are risks that exist in a bond which are basically indicative of the fact that the bond may not be repaid, bond has a high likelihood of not being repaid, such kind of a risk reflects in the price of a bond. And such kind of risk reflects in the price of a bond, and such kind of risk is called credit risk. So credit risk also gets reflected in the price of a bond. Just to give you an example, let's say today you buy bond of HDFC Limited, and I'm HDFC Bank, sorry, Limited no longer exists, HDFC Bank. HDFC Bank issues a bond. Okay, don't ask me what bond, which bond. Think of it as some normal bond for 1,000 rupees. Okay, and it is at 10% interest rate, and market interest rate is also G6. Currently the interest rate is about 9% or 8%, whatever, for that tenure. So they are operating at a spread of G6 plus 100 basis points. Because HDFC Bank is a AAA rated entity, that spread is more or less okay. Now that is assuming they're AAA rated. What does AAA rated means? Highest form of credit rating, no risk, no credit risk is there. However, suddenly let's say some large gapla happens in HDFC Bank. I pray it should not happen, because I have also invested money in that bank as an equity shareholder for quite some time. But let us say something happens. Then what will happen? Let's say huge NPAs, some large group has defaulted, all their money is lost and all of that. HDFC Bank will not repay this bond, or there is a very high probability that it will not repay this bond. Or even if it repays this bond, it will not repay 1000, it will say, boss, mere paas paisa nahi hai, I don't have money, I will not repay 1000, whatever is there, we will go through the liquidation process. For this 1000 rupees, you will probably get 200 rupees. Why 200? Because I have losses, all my losses equity holders anyway will absorb, but even after absorption by equity holders, there are a lot more losses, all of that has to be absorbed by bond holders. This happened, by the way, in 81 bonds in Yes Bank. Okay, so just Google around what is Yes Bank 81 bond story, you will understand that. So you have to absorb the losses. So the bond price, see, when bond yield, it is issued at 10%, market rate is also 10%, it will trade at same 1000 rupees. Suddenly next day morning you discover that there are all these losses and the bond prices cannot be 1000, it has to come down to 200 rupees. Now you see, interest rate is same, but price has fallen. Price has fallen even when the interest rate is not changed. Why? Because there is an element of credit risk. So bond price is a reflection of both the interest rate risk as well as also the credit risk. So when the interest rate changes, the bond price fluctuates. That is assuming the bond is recoverable. If the money that is recoverable itself is very small, then obviously the value of the bond will go down, right? So that is basically a credit risk that exists in any kind of instrument. Now, when you are looking at bonds, bond is what? A form of a loan, right? Now, a company issues a bond, a bank gives a loan. Now, bank gives loan to people like you, me, housing loan, auto loan, personal loan, then they give corporate loans, they give varieties of loans. Does credit risk exist for all these loans? Of course, it exists for all these loans. You and I, we have something called as a CIBIL score. A company is also, they evaluate the credit worthiness. There is a credit rating attached to every company. So, institutions like ICRA, CARE, CRISIL, we discussed about this, right? They get a credit rating and we get a credit score. Based on these two, they assess our riskiness, and then there is always some minor or major, some amount of credit risk. That is, if it is major, nobody will lend, okay? Everybody will assess the credit risk, and based on the credit risk, they will lend some money. When a company is borrowing from HDFC Bank, in this case, the company is the borrower, HDFC Bank is the lender, HDFC looks at the credit worthiness or the credit rating of the borrower, correct? Same way, instead of approaching the bank, the company borrower can also approach market by issuing a bond. Instead of borrowing from HDFC, they're borrowing it from the market. Who is market? People like you and me who invest in the bond market, right? So, the company, when it issues a bond, also it is borrowing. When it is borrows from bank, also it is borrowing. In both the cases, it is borrowing only. And that borrowing always has a default risk that the company goes bankrupt and HDFC does not get money, or the individual investors like you and me who invested in the bonds do not get money. That is one case. And second case I have explained, a bank itself issues a bond. The bank itself issues a bond because it also needs money, right? Bank, how does a bank operate? Based on our deposits, they lend it to other people. Also, banks raise money through bonds. They issue short tenor bonds, long tenor bonds, and they raise money. Okay, so credit risk, also known as counterparty or default risk, involves non-fulfillment of an obligation by counterparty. So this credit risk is there for banks when they raise money, it is there for corporates when they raise money, it is there for you and me when we borrow. So people check our credit rating, people check our CIBIL score. Okay, or it's called credit score. CIBIL is CRISIL's thing. So CIBIL is a specific score. You can have experience score or a bunch of others, high mark, CREF high mark score. There are a bunch of other scores, but they are basically called credit scores. Financial derivatives can be used to hedge the market risk. Credit derivatives emerged out to mitigate the credit risk. So if you think of an example of, let's say, I'll take RIL, Reliance Industries Limited. It has shares. Shares are listed. On these shares, I wish to buy, I buy, or I can enter into a futures contract. Correct? If I believe that the share price will go up, I will buy future, right? Now, what is this futures contract doing? This futures contract is trying to tell you, or when you enter into a futures contract, it is helping you hedge the risk of increase in share price. So, if you agree to buy today, instead of buying tomorrow, you will be ending up buying at today's rate instead of tomorrow's rate. Or let's say today's spot is 100, futures price is 110. I know Reliance is in thousands, but I am taking a simple example. You believe this 110 is not representative, actually the price should be 200. So you will agree to buy at 110 itself. Forget MTM, settlement and all of that, just think simply, okay. You are agreeing to buy at 110 because you believe that price will go up to 200. What risk are you hedging here? You are hedging the risk that the price increases from 100 to 200 and you are going to still buy at only at 110. Okay, you are going to buy at a low rate even though the price is increasing. The risk is of change in this particular price. So, if you come back and reread this again, financial derivatives can be used to hedge the market risk. So, the risk that the price of the particular share is changing in the market. Same way for bonds also, right? The change in case of bonds, it is about interest rate. Now, credit derivatives they emerged in order to mitigate the credit risk. So, credit derivatives are fundamentally derivative products that hedge credit risk. So, I will give you a simple example. I will not explain to you, what kind of an instrument it is and all of that. Just imagine you are my favorite bank, which is HDFC. You have lent money to RIL, let's say 1000 crores. Now, you are exposed to risk of non-repayment. RIL does not repay you money. How do you hedge that risk? You are exposed to credit risk. You are exposed. You as HDFC Bank are exposed to credit risk. As a bank, it is your duty to be exposed to credit risk. You are basically long credit. So, I am using words very carefully. Please don't long credit risk. Please don't think that is a very casual usage of words, because I will bring out linkages to these words later on. You are long the credit risk. It is the duty of a bank. Bank is what? Bank is a factory of credit. You would have studied in childhood economics. No, what is a bank? Bank is a factory of credit. They churn out money. They get money. That money multiplier effect and all of that stuff. Based on CRR, you have deposits increase, then more loans can be given. All of that. Basically, they are supposed to take credit risk. However, if a bank wants to somehow manage this credit risk, somehow reduce this credit risk, somehow ensure that the credit risk that they exposed to this RIL, they sell off the risk, they retain the loan. See, one way to not have the risk is to sell this loan to ICICI Bank. You sell the loan to ICICI Bank, ICICI now has the risk of the loan repayments, interest servicing, and as well as the credit risk. Right? Loan repayment is basically credit risk. So, both interest as well as principal obligation, both the risks are now with ICICI. But let us say you want to receive interest, but you don't want the credit risk that they will default. Twisted case, right? I will lend you money, I want the interest, but suppose you default, then I want to protect myself. Very good idea. This is kind of guarantee, surety, insurance, right? I will ask somebody else to provide surety, I will ask somebody else to provide some guarantee, or I will buy an insurance product on you. All of this is possible, right? I mean, think of it logically, don't get too deep into concepts. Think of it from a superficial perspective. You are originally long the risk, now you want to short the risk, short the credit risk. Why? So that there is no risk on your books. Your long means plus, short means minus, both of them cancel out, the risk on your books does not exist. But you will be still exposed to variations in interest rate and all of that, and installments will come in or some prepayment may happen, all of that is independent. Pure credit risk, the risk that repayment will not happen, that is what you are not exposed to. I said earlier prepayment and not repayment, please note. You are still exposed to prepayment risk, but you are not exposed to non-repayment risk. If you short the credit risk, originally when you lent money, HDFC, they were long credit risk. When they sell off or when they enter into some kind of a credit derivative transaction, they are shorting that risk and both of them get cancelled. The risk is hedged, the risk is mitigated. One is long, one is short, both of them cancel. You don't have the risk, but you can still short. Oh, of course, that can also be done. We will discuss about that also. Okay. So, this is what is a financial derivative, a credit derivative. Accordingly, the credit derivative is a mechanism whereby the risk is transferred from the risk-averse investor, someone who does not like the risk, HDFC Bank does not like the credit risk of RIL, to those who wish to assume the risk. They may sell this risk to ICICI, which is basically selling the whole loan, or they may sell it only to Axis Bank. In Axis Bank, they will sell only the risk. To ICICI, they will sell the loan plus risk, or they can sell only the risk to Axis Bank. You can sell only how is it done? I will explain. Okay, there are multiple types of credit derivatives. we will look into two types of credit derivatives called credit default swaps and collateralized debt obligations. Okay, credit default swaps, please note these words, credit default swap and collateralized debt obligation. These two are given in reverse order in our study material, but I have purposely changed the order because it is more logical to understand this way. And they have not explained a bunch of things very clearly in the material. They have gone random, haphazard, absolute haphazard. So I will go in a slightly different structure. I will explain everything that is there in the material. Please don't worry. But I will actually explain slightly more so that you actually understand what is it that they are talking. Because our institute is extremely famous for guesswork. They expect students to guess. They will give one line here, 3 words will be missing, another line, and we are supposed to understand, guess what is there in between and understand the concept. Okay, I am just joking, but that is what I believe they have done with this topic. Anyway, what are credit default swaps? So, there are two kinds of credit derivatives we are talking about, credit default swaps and collateralized debt obligation. First, credit default swap, then collateralized debt obligation. What are credit default swaps? See, CDS, or they are known as credit default swaps, are known as CDS. Okay. Is an insurance against the risk of default on a debt, which may be debentures, bonds, etc. Okay, before I forget, I should tell you this. There is this movie called The Big Short. I think it is there in Netflix. I think I have given the link of the movie also in my list of movies you should watch. This movie is about the Lehman crisis. Phenomenal movie. It is slightly, above 18 kind of a movie, but there are bits and pieces of it. But largely, the movie is bang on. Okay, it is an extraordinary movie that is taken. It has gone rave reviews. Okay, so this movie is all about CDS and bunch of other stuff. It's very interesting, and it is not explained in a fancy manner. It is very super simple manner. Okay, it is a lot of fun. You have amazing actors who have acted in it. Brad Pitt, then you have these guys, Ryan Gosling, bunch of guys. Okay, I love the movie. Anyway, coming back. CDS is an insurance against risk of default on a debt which may be debentures, bonds, etc. So, I was explaining to you about HDFC Bank, I was explaining about RIL and bunch of stuff. CDS is a product where you can hedge the risk of a loan or a bond. Only risk, what risk? Again, not market risk, interest risk and all of those risks, not financial risk, credit risk only. CDS is an insurance, it is an insurance, literally speaking it is an insurance, that's all. You should not overcomplicate, it's an insurance against the risk of default on a debt which may be debentures or bonds or etc. It can be loan also, okay, debentures, bonds are also varieties of loans. Let us understand, credit default swap. What is a credit? Credit is basically you have given a loan. When there is a bond that is issued, when you as a company, let's say you are RIL, when you are issuing a bond, you are taking a loan. So, this is a loan. And who is giving you the loan? People who are investing in that bond are giving the loan. Default. You default. Reliance Industries is defaulting, then who are not going to get paid? The investors are not going to be paid. If the bond is purchased by, let's say, a bank, the bank is not going to get paid. If you and I purchase the bond, we are not going to be paid. Swap. Exchange of liability or risk. So, in case there is a loan given and that loan is not repaid, there is a exchange of liability or risk. That is what is a credit default swap. If Reliance defaults, somebody will pay you something, which is exactly like an insurance. If I take an insurance, term insurance policy, something happens to me, then my nominees get some money. Correct? That is what an insurance contract. In this case, if I am a bond holder, if I am a bond issuer, I default, the person who purchases a credit default swap will basically make money. Just like I purchase an insurance, my nominees or my descendants, whoever is there, they will get some money. In case of a credit default swap, anyone who purchases a credit default swap on RIL, specific bond, if the RIL defaults on that bond, that CDS holder will make money. Okay, let us move further. The buyer of a CDS gets protection against the default of a bond or a debenture from the seller of the CDS. So, buyer, so I am an insurance buyer, you are an insurance seller. Insurance seller is protecting the insurance buyer. Insurance buyer is who? Someone who has already purchased a bond of RIL. So, I purchased a bond of RIL, I am scared RIL will go bankrupt, so I will buy a CDS. You are an insurance provider and this is not normal insurance company, okay. I am just using the word insurance to help you understand that this is kind of an insurance contract, okay. The insurance, this kind of insurance is actually done by banks, large investment banks like Deutsche, Goldman, Lehman, which was doing it, JP Morgan, Morgan Stanley, a bunch of these banks, Nomura, BNP, here's a huge list of banks, right. The buyer pays a periodic premium to the seller, who in turn assumes the default risk. So, CDS. Okay, let us call you as student A. Student A, okay, goes and invests money in AB Bank. Invest money not in AB Bank, but a bond issued by AB Bank. Let me not call it a bank actually, let me change it, AB Limited. AB Limited. They were going to issue money in AB Limited. Now, let us say the student invests 1000 rupees. Okay, that is what the money they have. Now, if you have a doubt that AB Limited is may default, what you do is you approach Deutsche Bank. Okay, Deutsche Bank doesn't do deals for all chutku 1000, okay, I'm just saying. You approach Deutsche Bank. You will say, sell me CDS. What is a CDS? Credit default swap. So, student A is buyer of CDS. Deutsche Bank is seller of CDS. If default happens, what is default is also defined. It is not that default means you don't pay. No. There is a logic to what is default. Please wait. If default happens, seller will buy bonds. Seller is DB, Deutsche Bank, will buy bonds from student A, that is buyer of CDS, okay, at par value. उसके बाद after the seller of CDS, okay, once the Deutsche Bank buys the bonds, whether they get any money, don't get any money, whether they throw the bonds in dustbin or they shred them or whatever they do is of no consequence to student A. Student A is buying an insurance. If AB Limited defaults, I will give you the bonds, you give me the par value of the bond. Okay, for this, buyer of CDS will pay yearly premium. To whom? To Deutsche Bank. So, the bond is, let us say 1000 rupees bond, 5 years. Every year I will pay 10 rupees as premium. Why, how? It depends on credit rating, it depends on liquidity, whether Deutsche is willing to do, whether you are a big enough person who wants CDS, all of that. So, you basically, student A is able to hedge the risk on these 1000 rupees of bond issued by AB Limited by buying an insurance in the form of a CDS from Deutsche Bank for this 1000 rupees for in case AB Limited defaults for 5 years by paying 10 rupees every year. In case this particular event happens, the default event, what is default also is defined. Okay, I told you what is default is also defined. Default is not anything what event I think. Okay, it is defined. If this happens, then DB, the seller of DB means Deutsche Bank. Okay, Deutsche Bank. The seller of CDS will buy the bonds from student A, which is the buyer of CDS at par value. Please note one more thing. Student A is originally long bond. Long means you have, right? Long risk on AB. Then they went long CDS which implied they shorted risk on AB. So now no risk on AB. I hope you have understood this. Initially you purchased a bond. Then when you buy a bond, it means you have credit risk on AB, right? You are long risk, you are exposed to risk. So you purchased a CDS, which meant you have sold the risk. So which means you have shorted the risk on AB. So this plus and this minus get cancelled and no risk on AB now. Okay, so when you are buying a CBS, you are basically shorting the risk. It is something counterintuitive. It is counterintuitive. Okay, this is something that you need to know. Now, after having understood this, let us come back. The buyer of CDS gets protection against default of the bond or debenture from seller of CDS. Agreed. The buyer pays a periodic premium to the seller, who in turn assumes a default risk. Correct. That is what I have told you. What is default? We will see. In case default takes place, there will be a settlement, and in case no default takes place, no cash flow will accrue to the buyer like an option contract, and the agreement is terminated. Although it resembles the option, since the element of choice is not present, it resembles a swap arrangement. Now, two things. If no default happens, this 10 rupees is gone. Insurance, if you take a term insurance policy, I hope all of you know what's a term insurance policy. Please note, as students of finance, you are not supposed to invest in an insurance policy like ULIP or any of those endowment plans and all of that. You are supposed to buy only term insurance. Term insurance is the purest form of insurance. You will not get any money back when you are alive. Okay, that is the purest form of insurance. That is what you should do, because it is the cheapest form of insurance. Okay, you are not supposed to get into all this ULIP policy. ULIP policy is the biggest scam of the century. Okay, please don't do this. I will do a separate video. You can check it out, all of that, because that's not part of our syllabi. But I'm just telling you, you will not recover any money in a term policy when you are alive. Your nominees will get money in case something happens to you. That is the best form of insurance, because that is the cheapest form of insurance, because there only your mortality, that is basically alive or dead risk, that is what is considered. Investment, that money put somewhere else, the broker commission, all of those are ignored. Buy a term insurance policy directly from the website of an insurer. Okay. So this 10 rupees is like the term insurance premium. Once you pay, you will not get it back. Only thing that will happen, in case there is a default, in case there is a insure event, which is basically death in case of a term insurance policy, then you will get a payout. Okay, so that is one important aspect. Then, although it resembles options, since the element of choice is not present, it resembles a swap. Why is this resemblance? What is this choice? There is no point after they have defaulted, after AB Limited defaults. Are you such a brilliant person and you will go and tell this Deutsche Bank, see, they have defaulted, but however, I am so generous, I will not exercise my option. So let me bear the burden. Why are you entering into an insurance contract? First of all, to ensure that your risk of default by AB Limited is, you have mitigate that risk. If AB Limited defaults, will you go and write off the money and say that, no, Deutsche Bank, keep the money with you, don't pay me money? No, such kind of things nobody does, right? So there is no optionality. You cannot choose to, there is no exercise, because the event is almost given. 100% this will happen when I have this. When this event happens, I will definitely do. I will definitely exchange, or rather I will definitely give away the bond to Deutsche Bank and take the money. Right. So there is a swap. What is a swap? Bond is given and your money, that par value of the bond, is received, which is why it is called as a credit default swap and not a credit default option. It is not an option, but it is a swap. However, pricing, when it is done, you will probably use option pricing techniques and all of that. That's a very different thing. Okay, let us not get into that. That is, thankfully, that is not there in our syllabus, because it is an absolute hardcore math. I remember I had done some basic stuff in one of the courses I had taken in ISB called financial engineering. It was absolute nightmare. It was very, very difficult to understand what was going on. They were all talking in third derivative, fourth derivative, and I don't know. I mean, it was very tough. Okay, so thankfully it is not there as part of our syllabi. But if it is there, it is going to be, it is very, very, people who have proper math background or statistics background will understand it better. Okay, a lot of CA students are don't necessarily have a great math background, so no harm in that. We are good in something else, let us be good in that. Okay, so this part, that is, it resembles an option, but since there is no choice, it is like a swap, is what you have to remember. Okay, and how it is priced is not part of our syllabus. Let's move forward. Now, I told you default events. What are these default events? This is not there in our material. I've added this. I've gone and searched in CFA material and come back. Okay. This is primarily there in US. We don't have CDS in India. We don't have great credit derivatives. RBI tried introducing all of this, but I don't think anything great worked out on it. Okay, RBI is scared of normal interest rate swaps and normal foreign currency derivatives itself, because they're very tight control. Because when 2007-8, when this whole Lehman Brothers collapse happened, rupee depreciated sharply, then all these fancy structured derivatives in all these exotic options we were discussing, no, all these exotic options, all the buyers of exotic options lost money. There was absolute nightmare, blood in the market. Okay, so RBI is super careful when they allow anything like these kind of fancy derivatives. Okay, so these are not there in India, they are largely in US and to a certain extent in Europe. Coming back, bankruptcy. What are the default events? When do you call a bond or a kind of a loan to have defaulted? Bankruptcy. A bankruptcy protection filing allows the defaulting party to work with creditors under the supervision of the court to avoid liquidation, full liquidation. So basically, when you go bankrupt, you have certain filings, Chapter 7, Chapter 11, some filings in US, where you go and make a particular filing saying that, I am bankrupt, kindly, do either liquidate me or don't liquidate, or, reduce the pay. We have liquidation chapter, no, you would have studied in CA Inter, where you talk about there's a reduction in the value, there is a restructuring and all of that, same stuff, something very simple, similar. Whenever there is any such kind of bankruptcy filing, it is treated as default. A bond is said to have defaulted when there is a bankruptcy filing by the issuer of the bond. That is the first aspect. Failure to pay occurs when the issuer misses a scheduled coupon or principal payment without filing for formal bankruptcy. Even though you have not filed for bankruptcy, apparently everything is very, very good, you are in the pink of your health, suddenly one day you don't pay your EMI. Okay, for us, for home loans, it may happen. For a large company, RIL, which has 1 lakh crores of loans, if they don't pay 1,000 crore installment, market will crash. Correct? So, things like that will happen. If at all large payments are missed, that is also treated as some form of default. Under what? Under credit default swap arrangements, not for any other arrangement. For CDS, you will treat bankruptcy filing or failure to meet an obligation in terms of interest or principal payment is called as basically a default. And restructuring. It occurs when the issuer forces its creditor to accept different terms than those specified in the original issue. So, one day you come up and say, all my dear friends, creditors, I will pay you only $10 cents a dollar. 10 cents a dollar means for every $1 that you have given me, I will pay you only 10 cents. Gone. You may come up with any such kind of restructuring proposal, it is treated as a default to qualify for a payment under CDS. So, these are the three things which are categorized as defaults under CDS. Okay, it is not randomly, anything cannot be called as default, or completely last day, last installment on the maturity date, amount is not paid, then we will treat it as default. Such kind of bullshit explanations don't work. What works is any of these three things, and these are defined in the CDS contract. It is not that these are market terms and all that. These are defined in the CDS contract. Now, let us come to the next aspect. What are the main features of CDS? I have already explained to you a lot of this story. So, you would have understood by now what the features are. Let us see. It is non-standardized private contract between buyer and seller, therefore is not covered in the category of forward contract. So, it is between two parties. I told you about student A and I told you about Deutsche Bank. It is only between those two. It is not traded on an exchange. You can define what is default. You can define that, if this covenant is missed, okay, no problem, it is not default. If the company is supposed to maintain a DSCR, what is DSCR? Debt service coverage ratio of, let us say, some 3. Let us say by mistake it is only 2.9. You can define. If the company's DSCR at the end of Q1, Q2, Q3, Q4 is not 3, but probably 2.5, up to 2.5 I have no problem, I will not treat it as default. You can agree. It is between you, student A and Deutsche Bank. Whatever you want to do, you do. Then, therefore, it is covered in the category of forward contract. I think I said it is not covered. Therefore, it is covered in the category of forward contract. So, forwards are contracts between two independent parties. They are over the counter. Please note the word over the counter. See, you are CA students. You are supposed to use terminology that actually reflects your understanding, key terms. Okay. So, most of these contracts are over the counter and are not traded on an exchange, recognized stock exchange, recognized any kind of exchange. Okay, these are not normally traded on any exchange, that is what I was telling, and hence remains free from regulations of governing body. So, in US, these kind of contracts are kullam kulla, you do whatever you want, if you gain, you loss, it is your headache. That is why 2007 collapse happened, because nobody was regulating them. Nobody was regulating them. It was absolute massacre in the markets that day. I remember I was working in BNP. Morning we had come to office and we learned that yesterday night Lehman Brothers has collapsed and Bank of America is now in the process of taking, and Merrill Lynch also collapsed and Bank of America was in the process of taking over Merrill Lynch and all that. Markets collapsed, like Indian market, Sensex, Nifty, everything was down. Crazy. I mean, go and check in any of the websites of prices of, I think it was September 8th or October 8th, I don't remember exactly, 8th September or 9th September 2008. Go and check the prices of Nifty or whatever levels of Nifty and BSE Sensex on that day. You will realize the enormity of the crash. It was painful. So many people lost jobs. Okay, we have not, thankfully, we have not seen another crash from then till 2000, whichever year we are in 2020s. Okay, anyway, regulations, which is why RBI is super careful of all of this. They won't allow all this, tomfoolery. Tomfoolery means, doing stupid things. They are super careful. These are all not required for us. But again, that is also bad. You should have some regulation, and these are very important tools of managing credit risk, not financial risk, managing credit risk. ISDA, International Swap and Derivatives Association, publishes the guidelines and general rules used normally to carry out a CDS contract. So, ISDA, I have also am aware of what an ISDA contract is. I have signed it. ISDA is basically it's a International Swaps and Derivatives Association. It's an association formed by all these big players. They come out with standards, even though there is no regulatory body, self-regulatory body kind of a thing, where they came out with some kind of documentation which says this is the document that you are supposed to follow if you are entering into a CDS. We entered into it when I was in Coromandel, we entered into ISDA for normal forwards and MIFOR swaps and all of that. Interstate swap, cross-currency swap and all of that. We didn't have any of these fancy credit derivatives because they're anyway not traded in India. CDS can be purchased from third party to protect from default of borrowers. So, if you come back here, who is Deutsche Bank? How is Deutsche Bank related to the student? How is Deutsche Bank related to AB Limited? So, this is party number 1, this is party number 2, this is party number 3. So, party number 1 is buying from party number 3 something in order to hedge of risk of default by party number 2. So, it can be purchased from a third party completely, someone who is not even linked to the entire transaction. Not necessarily, but yes, you can have, Deutsche Bank also is the banker of AB Limited and all of that, but keep that aside. Generally, it's a third party. An individual investor who is buying bonds from a company can purchase CDS to protect his investment from insolvency of that company. Thus, this increases the level of confidence of the investor in the bonds purchased. Exactly our example. So, student A purchases the bond and he also purchases the CDS. He or she, okay, and because of that, the bond, they are safe, they are happy that this bond, even if there is a default, nothing will happen to me. Then, the cost of premium of CDS has a positive relationship with the risk attached with the loans. Therefore, higher the risk attached to the bonds, higher will be the premium of the cost of CDS. So, imagine here, this 10 rupees, I randomly gave 10 rupees. Think, this is a very good example, okay, and I don't wish it, but I am generally saying, let's say you want a term insurance policy. You are a chain smoker, every day 10 packs or one full, whatever vape that you use, every day one bottle of vape. Then you drink all kinds of alcohol available in the world, okay, and then you go and ask for term insurance. Term insurance fellows will do a medical test for you. They will find out that you are a chronic smoker and they will also find out that you have excellent alcohol quantities in your body. They will say, boss, if you want a 1 crore insurance, please pay me 25 lakhs. For 1 crore insurance, pay me 25 lakhs as premium every year. Why? Because we know for sure that in the next 3 or 4 years, given your brilliant lifestyle, very sure that something will happen to you. And hence, we will have to pay 1 crore, so please pay me 25 lakhs as every year premium. Right? Let us take another fellow, full gym body, every day, morning to night. That fellow exercises, no alcohol, no smoking, no drugs, full fit body, eats very, very carefully, BMI index is solid, less than 24, 25, whatever they say, and perfectly healthy human being. That person, for same 1 crore policy, it will be 500 rupees. Annual premium is 500, not 500, let's say 2000 rupees is annual premium. For you, drinker, smoker, drug addict, the premium is 25 lakhs. For the other person who is a healthy person, who is non-drinker, non-smoker, non-drug addict, never touched any of those, premium is only 2000 or 3000. Why is that the case? Obviously, because there is a very high risk that something might happen if your medical history is not good, or if your behavior is not good, or if your habits are not good. Same logic applies here, which is if AB Limited is a known chore, known defaulter, known thief, then Deutsche Bank will say, what 10 rupees man, 1000 rupees loan, if I have to insure you, I will charge 500 rupees as premium. No, then I cannot pay premium. I don't pay. I don't sell you in CDS. If however, AB Limited is AAA borrower, super clean financials, solid corporate governance, 100-year history, never defaulted. Entire family has never defaulted. Everybody in family has 800 credit score. Then they will charge 10 rupees premium, right? So the premium is linked to the risk perception of AB Limited. If AB Limited is very risky, the Deutsche Bank will charge very, very high premium. AB Limited is not at all risky, super credit rating, they will charge very low premium. Okay, it's a very commonsensical thing, it is nothing fancy, but you have to understand that particular aspect, that risk and the premium are directly correlated. Risk and premium, investor buys with the cost of premium has positive relationship. Positive means direct relationship with risk attached with the loans. Therefore, higher the risk, higher the premium or cost of CDS. What is the next one? If an investor buys a CDS without being exposed to credit risk of underlying bond issuer, it is called naked CDS. We will take an example. Excellent example I have. Student A has invested in a bond of AB Limited. Every day this fellow is scared whether AB Limited will default, not default, what will happen, and he is continuously researching about AB Limited. He realizes this company is a gone case. Let me go to Deutsche Bank and buy a CDS. Then he will go talk to Deutsche Bank. Deutsche Bank will sell some CDS, 10 rupees, 20 rupees, 50 rupees, whatever it is, student A buys. When doing this research, student A tells all his troubles to student B. Student B, smart fellow, or smart girl, smart boy, whoever it is, smart person. Acha, you're going through all these problems. Oh, okay, really sorry about it. Fine. Suddenly, student B gets a brilliant idea. You are buying a CDS, and if AB Limited defaults, you get money. And what will that money? You initially invested 1000. If the AB Limited defaults, it will become minus 1000 because you will sell off the bond, or you will give the bond to the Deutsche Bank. Then you will get back your original 1000 back. So basically, you got your original 1000 back. Student B has not invested in any bond of AB Limited. Student B will say, you are doing, and you have done all research. Student B trusts student A. You have done brilliant research. Now let me see, why don't I make a money out of this whole deal? Why don't I make some money out of this deal? You know, student A knows that bond of AB is 100% default scenario, which is why student A went and purchased from DB, Deutsche Bank, a CDS. Student B also realizes, arey boss, this is a nice opportunity. He knows for sure that this bond is going to default. Let me also buy one CDS. Arey, but you don't have a loan. No problem. I have 10 rupees. Every month I will pay 10 rupees to Deutsche Bank. What is there? I will lose money. So be it. Small money, no? So what happened here? Without having an original bond, you have entered into a CDS. And you are saying, if the AB Limited defaults, Deutsche Bank will pay me money. At that particular point of time, you have to deliver a bond or whatever, you will figure out, you will buy something from the market at one, kacharaka paper, waste paper, no, and give it off to the Deutsche Bank. That's all. What is there in that? Or even that may not be required. So what you are basically doing is, an investor buys CDS, student B, without being exposed to credit risk of the underlying bond issuer, without having purchased a bond of AB Limited, then it is called a naked CDS. Basically, you are not exposed, even then you are buying. So you are entering into you are shorting a risk. See, when you initially purchase a CDS, I told you are shorting a risk. When you purchase a bond, you long the risk. When you purchase a CDS, you are shorting the risk. Here, you have shorted the risk it's a naked CDS because you don't have a back-to-back loan transaction for which you are taking the CDS. That is called as a naked CDS. Okay, let us move to the next aspect. What are the uses of CDS? We will see. What are the uses of CDS? One is hedging, one is speculation, one is arbitrage. There are three uses. What is hedging? Student A purchased a bond of AB Limited and they want to now hedge, right? Main purpose of using CDS is to neutralize or reduce the risk to which CDS is exposed to which reduce the risk CDS is exposed to. Thus, by buying CDS, risk can be passed on to the CDS seller. So, basically, you are, a student A is buying something from Deutsche Bank, correct? Hedging, you already have a bond of AB Limited, against AB Limited bond you are buying a CDS. I'll come to arbitrage. First let us see speculation. Speculation is the naked CDS, which is a CDS can also be used to make profit by exploiting price changes. For example, a CDS writer assumes risk of default will gain from the contract if trade risk does not materialize during the tenure of the contract or if compensation received exceeds potential payout. So, this is not naked CDS, this is other kind of thing, speculation. Why is Deutsche Bank doing this whole stupid exercise? Why are insurers insuring us? Because they believe there is a profit in it. Because they believe they are measuring the risk. Now, what is risk here? Let us not get into standard deviation and all of that. It is all linked to that only. But I am basically saying they are measuring the risk and they are saying this is the risk. I will charge you some premium over the risk and take some money. So, I will potentially make money. See, how does term insurance work? I will collect money from lot of people. If from each fellow 5,000. Okay, 1,000 people I collect 5,000 rupees. 1,000 into 5,000 is what? 50 lakhs. Okay, every year I collect 50 lakhs. Like that for 10 years I collect 50 lakhs. It is 5 crores. In those 10 years, out of those 1,000 people, how many will die? 1 person or 2 people. Or out of that 5 crores, I will pay probably 1 crore. That's all over. Balance is my savings. Now, how did we arrive at a figure that only 1 person will die or 2 people will die? That is what you do as measuring risk. So, you have actuaries who measure risk in life insurance related stuff. In case of credit derivatives, you have people who are expert at measuring the credit risk. Okay, and that is how they arrive at the risk, how risk can be priced. Okay, so those people, that is people like Deutsche Bank, can make profit by selling CDS. So, every month they will collect 10 rupees, 10 rupees, 10 rupees, 10 rupees. Like that they have collected 50 rupees. Let us say the company defaults. When the company defaults, Deutsche Bank will get the bond and Deutsche Bank will have to pay value of the bond of 1,000 rupees to student A. 1,000 rupees they will pay off. They have collected 50 here. When they sell the bond now or when they wait for bond to be paid out by the company or whatever it is, right, let us say they get 980 rupees. And how is it possible? Because the meaning of default, word default is defined separately. So, if any of the term gets hit, it is default. So, they are paying out to the student only 1,000, but then they are making 980 from the bond, they are making 50 from the premium, so they are actually making more money. So, it is possible, right? There are cases where it is possible. See, I have given a simple example of 10 rupees. It may be 100, 100, 100. Then what? Let us say every day 100, every month 100. So, 5 months 500. What is there in this? Even if the bond is sold for 600 rupees also, Deutsche Bank has made money, right? So, the recovery value may be higher, recovery value plus the premium may be higher than the payout for Deutsche Bank, in which case they will make money. So, CDS writer assumed risk of default will gain from the contract, the credit risk does not materialize. Let us say the AB Limited doesn't default, every month I have got 10 rupees, no, free of cost. I have taken a risk, the risk is not visible, risk is only in a contract, risk is not materialized. If the risk doesn't materialize at all, I will make the 10 rupees. During the tenure of the contract, if the compensation received exceeds potential payout. So, 600 plus 500, which is premium plus money recovered from the asset, is more than 1,000 rupees what you have to pay, what Deutsche Bank pays to student A. Okay, so this is 2. Then there is something called as 3, arbitrage. What is this whole arbitrage story? It involves buying a CDS. So, student A is buying a CDS and entering into an asset swap. What is an asset swap? We will see. For example, a fixed coupon payment of a bond is swapped against a floating interest stream. So, this is slightly complex. They have unnecessarily given something which without explaining into greater depth. So, and they mix 2 things. So, I will explain it simply, do not worry about it. What is arbitrage? In 2 markets, in one market something is cheaper, in another market something is costly. You buy cheaper thing from cheaper market and sell something in the costlier market. So, what happens is this CDS is quoted as a spread. CDS is quoted as a spread. CDS quoted as a spread. So, usually everything in financial world, especially with bonds, CDS, most of these things are quoted as spread over benchmark. So, benchmark here is government yield, GSEC. let's say Government of India bond is right now at 9%. I don't know what tenure, let's say it's a 10-year bond, okay, randomly I'm making up some numbers, okay. This 10-year bond is at 9%. So, a CDS for a AAA rated RAL 10-year, right, RAL 10-year normal bond is at a spread of GSEC plus 200 bips. So, the interest rate is 11%. What they basically say is CDS is quoted as, for this particular bond, if you want to buy a CDS, it is 5%. They will quote this as some percentage, 5%. 5% over GSEC. What is the credit risk of a GSEC? 0. Government of India, credit risk is 0. Government of India will, if they don't have money to pay you, they will print money and pay you. Whether that money has value or not because of excessive printing, inflation is a different aspect. But they will pay you your money. That is, RAL can't print money, no? Right? So, this particular CDS price is quoted as a spread. So, 5% is the spread. So, premia, 5% premia is what is charged every year against a bond of RAL if you want to buy a CDS against a 10-year 9% coupon, annual coupon RAL bond. Now, why is this relevant? This is a fixed rate bond. Okay, this is a fixed rate bond. In a fixed rate bond, your inflow is 11%. Your outflow, what is outflow? Your CDS cost, no, 5%. And I again randomly put numbers. So, every year you are making an interest income of 6%. And this 6% is fixed. Logically, this should not be the case. Why logically it should not be the case? Because I told you here, RAL bond is priced as GSEC plus 200 bips. So, this should not be, the CDS should also be 200 bips only, 200 bips plus or minus some bips for as margin for the Deutsche Bank or some broker bank, whoever is in between. It cannot be 500 bips. If there ever arises a scenario, let us say instead of being 5%, let us say this is minus 1%, then what is your income? Your income is 10%. Your income is 10%. So, if this is the case, this particular, by buying a CDS, you are paying 1% premium and you are getting net income of 10%, and this particular bond is now as good as a government bond, whereas government bond is only 9% GSEC. Government bond, okay, GSEC is 9%. Whereas this bond, after eliminating credit risk, is 10%. Is there a possibility for arbitrage? Yes. What is the possibility of arbitrage? You borrow in one market, lend in another market. So, you keep buying bonds of RAL, entering into CDS of 1% and keep making 10% return, much more than Government of India's rate of 9%. And the key point to note, with the risk level same as GSEC. Why? Because credit risk is fully eliminated. So, you can do this kind of arbitrage transaction. Now, you can do fixed to floating also. Convert this fixed into floating, and then in floating, whatever, compare floating benchmark rate, and with that floating benchmark rate is much better than the current market floating, you will make some money. So, it's a variety of ways in which arbitrage can be done, right? But the idea is you can use CDS as arbitrage mechanism. It involves buying a CDS and entering into an asset swap. For example, a fixed coupon payment of a bond is swapped against a floating interest stream. Okay, so for example, whatever the bond every year, so let's say whatever this 10% is coming, you pay off this 10% every year and you keep getting inflows. Inflows of how much? You keep getting variable or floating inflows. And you believe this floating rate will go up. If the floating rate goes up, what will happen? You will get 11%, 12%, 13%, 14% like that. So, you basically are converting a fixed instrument, eliminating credit risk and swapping it out so that you get actually some income in terms of floating rates and you actually make more money. So, here you are negating the credit risk and at the same time you are also making money by taking a view on the interest rates. Okay. So, that is one way. It is unnecessarily convoluted and complex, ignore it. Okay. Who are the parties to the CDS? This is very simple. Initial borrower. Who is initial borrower? Student A, AB Limited, Deutsche Bank. This is AB Limited, called as reference entity. Also called as reference entity, who are owing the loan or bond obligation. So, AB Limited is a reference entity. Buyer called investor. Who is the buyer of CDS? the buyer of protection. The buyer will make regular payment to the seller for protection from default or credit offence. This is student A. I hope you are able to recollect what we discussed just 2 minutes ago. Seller, called writer of the CDS, makes payments to the buyer in case of credit event of reference entity. It receives a regular payoff from the buyer of CDS. So, who is this? This is Deutsche Bank. These are the three people involved. Very, very simple. You have to use this clear terminology. Initial borrower called as reference entity, buyer called as investor, that is buyer of protection, seller called as writer of the CDS. How is a CDS settled? There are two ways. This physical settlement, that is student A gives off the bond to Deutsche Bank. This is traditional method of settlement. It involves the delivery of bonds or debts of reference entity to the buyer or by the buyer to the seller, and seller pays the buyer the par value. Basically, student A gives off the bond to Deutsche Bank and gets 1000 rupees, the face value. Second, under this arrangement, which is cash delivery. This is cash, I think cash settlement. I think that thing got deleted. Cash settlement. Under cash settlement, seller pays the buyer difference between the par value and the market value of a debt. So, if the debt is listed, AB Limited bonds are listed, we will take a reference date, whatever may be the market value of the reference entity. To increase the transparency, a credit event auction was developed wherein a price is set for all market participants that choose cash settlement. So, at what price will Deutsche Bank pay? So, let us say student A holds the bond of 1000 rupees. In the market today, the bond is 60 rupees. Morning it is 60, afternoon it is 70, evening it is 80, and next day morning it is again 50. Deutsche Bank has to pay, either take the bond and pay 1000, or there is a mechanism set by which, who set this mechanism? All the participants in the mechanism, where they do a credit auction. To increase transparency, a credit event auction was developed wherein price is set for all market participants that choose a cash settlement. So, student A and Deutsche Bank will have to follow this process, and they will say, average of the last 10 trades, average of the last 1 hour, average of every tick or something. They will arrive at some number and say this is the price. They will arrive at a price of 45. So, Deutsche Bank will say, instead of taking the bond from you, I will pay you 1000 minus 45, which is 955. I will pay to student A. Student A can then do whatever they want with the bond. They have got this 955. In the market, they can sell the bond. If it is at 45, they can sell it. If it is at 35, they can sell it. If it is at 65, they can sell it. It is their headache. So, cash settlement is also done. This is a mechanism developed in the markets, where there is a credit event auction, this kind of a mechanism that they develop. Okay, very interesting topic, right? Now, CDS is the first topic that we have to understand. Then we have to go into the next topic, which is asset-backed securities and CDO. So, they have explained CDO without explaining ABS. That is I don't know what to say, that is a disaster, because you have to first understand what is an ABS, then you have to understand what is a CDO. Let us now move forward and understand what is a ABS. And there are credit linked note. You also got to understand credit linked note. My bad, actually. You have to first understand credit linked note, then you have to understand asset backed securities, then you have to come to CDO. Okay. First, let us go and understand what is a credit linked note. So, friends, now let us look at what is a credit linked note. As I said, first we'll look at certain basic credit derivatives, in addition to what we discussed just now with respect to what exactly is a credit derivative, what are CDS, and so on and so forth. Let us look at some other basic credit derivatives before we actually get on to CDOs, because the understanding of these is very, very essential when we go to CDO, especially the way the institute material is explained, where they have complicated and confused a bunch of things. So, I am trying to simplify it. So, this basic understanding is definitely required for you. First, we'll look at credit linked note. A credit linked note is a form of funded credit derivative. Okay, we'll come to it what it means. It is structured as a security with an embedded credit default swap, allowing the issuer to transfer a specific credit risk to credit investors. I will come and explain it again. Let me read the full paragraph. The issuer is not obligated to repay the debt if a specified event occurs. This eliminates a third-party insurance provider. It is a structured note issued by a special purpose company or trust designed to offer investors par value at maturity unless the reference entity defaults. In case of default, the investors receive a recovery rate. The purpose of this arrangement is to pass the risk of specific default on to investors willing to bear that risk. In return for higher yield it makes available. The CLNs themselves are typically backed by highly rated collateral such as US Treasury yields. Okay. Now, to simplify this part, there is a good example also that they have given. You will understand it actually better with this example. A bank lends money to a company called XYZ. So, please note, we have studied about securitization. In fact, this topic should have been integrated with securitization rather than with derivatives, because a lot of these aspects are covered in securitization. What did we discuss in securitization? There is an asset, there is a pool of assets. You transfer it to an SPV. the SPV issues a security, the investors invest in this particular security, and whatever money comes to the SPV keeps transferring it to the investors, right? This is broad securitization process. What exactly a credit linked note is? A credit linked note also has a very similar structure. There is a bank, in fact I think the diagram is already here, we should use this. There is a company called XYZ, that is what they said, right? A bank lends money to a company called XYZ. So, you lend money to a company called XYZ. Now, please note the difference between this and securitization. In securitization, you are pooling multiple mortgage loans or auto loans or car loans or whatever loans. You are integrating multiple. Here, you are talking about a single company. Oh, so that is the fundamental difference. Yes, that is the fundamental difference. The difference here is, it is about a one specific entity. A credit linked note is about the loan given to one specific entity. Can it be more than one entity? Typically, it is a one specific entity. So, bank has lent money to XYZ. Then what are they saying? XYZ, and at the time of loan issues, credit linked notes bought by investors. So, moment the bank has issued a loan or given a loan to a XYZ, it wants to offload that loan. It basically wants to offload the loan or pass on the credit risk of that loan to some other investor. That is the core idea. This sounds very, very similar like securitization. It actually is. Securitization is the process by which you do it. CLN is an instrument by which you are securitizing a specific loan receivable that you have from XYZ. Securitization is the process. CLN is an instrument that is part of that particular process. There are varieties of instruments. CLN is one such instrument. Then, at the time of the loan, issues a credit linked note which are invested by investors. The interest rate on the note is determined by the credit risk of the company. So, you see, the bank is through an SPV, again there is an SPV, whatever you do, there is an SPV, special purpose vehicle or a trust that is involved in between. You don't directly sell it. You basically give it to a trust and the trust sells it to an investor. So, the loan, theoretically, the entire loan is sold off to an investor, but let us see if there are any complications in that. And the loan, not exactly the loan, it is actually a note. So, you are creating another contract for which the underlying is this loan. So, it is not directly the sale of a loan. It is basically a contract which has underlying as this loan. Okay. So, you basically give this particular, sell off this note which for whom underlying is this particular loan to XYZ, you sell it off to an investor, along with some collateral. Why do you do along with some collateral? Because basically you want to provide some sense of security. So, you add some other basic, risk-free securities as part of the overall collateral. What is collateral? Collateral means security, right? So, you are basically taking money from third party, that is bank. Here let us call this bank as HSBC. HSBC is selling it to an investor. Basically, think of it as HSBC borrowing from somebody. Against what? Against a borrowing or a lending they have made to XYZ. Against that they are borrowing from somebody, and for that they have to again give collateral of some risk-free securities. Think of it that way. Simply, I will clarify it further. Okay, the interest rate on the notes is determined by the credit risk of the company. Obviously, the note, the security that you issue as HSBC to this investor, the interest rate on that is determined, or the return on that is determined by what is the credit risk of this XYZ. The funds that the bank raises by issuing the notes to investor. So, you basically have issued a note. That note has underlying of this particular loan that you have given to XYZ. And when I am saying you are HSBC here. You have given a loan to XYZ. That loan, based on that loan, you are creating a note called CLN. That CLN is sold to an investor. The investor pays you money. And the funds raised by bank by issuing the note, investors are invested in bonds with low probability of default. So, the money that you raise, you actually keep it with you and you invest it as in bonds with low probability of default, basically government securities. If company XYZ is solvent, the bank is obligated to pay the notes in full. So, if XYZ is solvent, that is nothing happens to it, it continues to remain solvent, it is servicing the interest and all of that, it is servicing the interest to whom? To HSBC. HSBC is supposed to repay the amount. What amount? This money what they have taken from the investor, they are supposed to repay it along with whatever interest they have agreed. Why? Because they have said no here. The interest rate on the notes is determined by the credit risk of the company. So, you basically determine an interest rate, you are servicing that interest. It is a loan on a loan. Think of it. You have taken a loan, against that you are downselling it and taking another loan, right? If XYZ is solvent, bank is obligated to repay the notes in full. If it goes bankrupt, the note investors become the creditor of the company XYZ and receive the XYZ loan. So, if at all XYZ defaults, then this entire loan gets shifted here to the investor. What you do? If the note holders, investors become creditor of the company and receive the XYZ loan. So, if company defaults, you are selling off the loan. If the company doesn't default, XYZ is still liable to HSBC. If the company defaults, HSBC is selling off the loan to the investor. The bank in turn gets compensated by the returns on less risky bonds funded by issuing the credit-linked note. So, you have downsold the loan and then the money is basically invested in some securities. On those securities, you are earning a low return. So, now see what basically happens in this, no? See, you have taken a loan and giving up the loan to somebody. Why are you doing this whole exercise? Why are you doing this exercise? See, what happens? How does a bank make money in this whole exercise? You tell me. See, typically what happens? Bank is selling to XYZ, bank is giving them a loan at, let's say, 10%. Now, when they issue a credit-linked note, they have to pay interest, right? The HSBC has to pay interest to the investor because they have borrowed money from the investor. So, when they borrow, will they borrow it at 11, will they borrow it at 10 or will they borrow it at 9? When will they make money? See, this is an inflow, this is an outflow. So, outflow has to be more or less, outflow has to be less, only then you will make money. So, what they will do is, they will probably do it at 9% or something and they will earn a 1% spread. And whatever money they've got, they've invested in some bonds or some government securities where they earn some 6 or 7%. Totally their return is 7% on this particular bonds because original loan what they have given is already part of a credit link note which you have downsold to somebody. So, the idea here is you are basically earning this 1%. You are earning this 1%. Now, why will this other fellow agree to do this 1% business? Because HSBC is the one who did all the initial activity. They are the one who went, verified, checked, everything. And subsequently, they are giving you a single based on some bunch of papers. They are actually willing to sell you the loan. Now, if this investor is not a bank, then how will they lend to this XYZ? XYZ will have to come up with a bond issue. That bond issue they have to subscribe. If XYZ is not capable of a bond issue, or XYZ is not done a bond issue, then how will the investor buy? Right, probably investor has some more knowledge on XYZ, right? So, they may take a bet saying that, I will not basically, I will try and give the XYZ loan can be taken only at 8% or 9%, okay? So, they may take bets like that. So, eventually the goal is transfer of risk. Now, you see what was a CDS? A CDS was a case where you are buying protection. Here, you are not buying protection, you are selling the asset itself, but in between there is a paper called CLN. In case of CDS, what could the bank have done? The bank could have purchased a CDS on XYZ. So, if XYZ defaults, somebody else will pay. Here, instead of purchasing a CDS, you are saying, I am selling the loan by in between keeping a paper called credit linked note. That's all. It is very simple and I will make some spread. Right. Now you come back and read this, you will understand much better. Credit linked note is form of funded credit derivative. Funded credit derivative is what? In a CDS, there is no funding. No, you are buying an instrument. That instrument, only in case of default you get paid. There is no funding that you have to do. Whereas in a credit linked note, the actual funding happens. That is, the investor is paying you money. It is structured as a security with an embedded credit default swap. Correct? No, it is. Why is it called an embedded credit default swap? Arey boss, if something happens only then you need not repay. In credit default swap, what happens? If bank is given loan to this XYZ, if XYZ defaults, this new investor will pay me money. That is what credit default swap. Here, investors in front paid money. The investor has upfront paid money to HSBC. And if XYZ defaults, then I will not repay. So, that is the distinction. So, it is structured as a security with embedded CDS. It has embedded CDS. That is, it is like a CDS, allowing the issuer to transfer specific credit risk to credit investors. Correct. You are transferring the risk. The issuer is not obligated to repay the debt if a specified event occurs, and this eliminates a third-party insurance provider. So, here there is no requirement for a third-party insurance provider. Directly you are selling the loan to an existing investor. Right. It is a structured note issued by an SPV company or trust designed to offer investors par value at maturity unless the reference entity defaults. In case of default, the investors receive recovery rate. So, the trust offers investors par value at maturity. So, on maturity, if the XYZ does not default, the SPV will do what? The SPV will basically, XYZ would have repaid all the money to HSBC. SP will repay the entire money back to the investor. Where? From this collateral or wherever it is. Okay. The purpose of this arrangement is to pass the risk of specific default on to investors willing to bear the risk in return for higher yield it makes available. So, this allows HSBC to earn some extra spread. The CLNs are typically backed by highly rated collateral such as US Treasury securities, mostly government securities. Whatever money that you get from investor, HSBC doesn't take that money away. HSBC basically invests that money in form of highly rated collateral, right? So, if you look at this whole thing, right? So you are giving some collateral and return, then there is a premium that you pay, this premium is passed on to the investor. So, basically the entire structure basically reflects some kind of a instrument which is similar to a credit default swap, but you are passing on the risk. Now, here I gave one example saying that it is 9%, 10%, 11%. Is it possible that it is not 9 but it is 11 only? That is, you are paying a higher interest to the investor than what you are actually recovering from HSBC. 100% possible. Why will you do that? Because what is a CDS? If HSBC has to buy a CDS, it has to pay a premium. So, that premium could be 1%. So, they are paying that 1% extra to the investors such that they basically are recovering, they are paying 1% extra premium to the investors so that their risk is protected. 100%. Now, when I said 9%, it was just to give you an example. It is 11%. Yes, it is possible. It is 9% possible. What is it usually? It is more probably between 11 and 9. Why am I saying that? Because there are always demand supply issues. It is not just always a pure CDS. There could be other company specific factors that could be at play. There could be investor related aspects that could be at play. The interest rates could be at play. There could be a variety of things. Will you say 100% is 11%? I don't know. It probably 50-50 chance. It could be 9, it could be 11, it could be 10, I don't know. But usually you add the component of the premium, you also subtract. So here this, when I say 11, 10 plus 1, that 1% will be probably premium. You also have a possibility of some, structuring cost, the loan cost and all of that. There could be a negative one. So, both of them are balanced and it could be either 11, it could be either 9. It doesn't matter. But the idea is basically you are passing on the risk. There could be transaction specific issues, how the pricing is arrived at. Okay. So, this is a credit linked note. This is what? This is a credit linked note. Why is this relevant? We will see. Let us now move to the next one. What is this? This is something called as an asset backed security. Arre baapre. What is this now? Asset backed security. You'll understand. What is an asset-backed security? Asset-backed security, again, just like our securitization, it is a pool of assets that consists of any debt like credit card debt, outstanding auto loan, student loan or any other debt. This is proper securitization, okay. You have asset 1, asset 2, asset 3. This could be all what? These are variety of assets. Each one could be varieties of loans. You are combining all the loans. You are basically now combining the book of a bank. A bank has textile loan, retail loan, auto loan, corporate incorporates. You have, as I said, textile, infrastructure, power, then, telecom. You have varieties of loans. You are basically pooling all those, credit card loans, everything. You are pooling a bunch of loans or receivables from loans, okay. You have a bunch of assets which are receivables, you are pooling them. Let us say the principal of that is 100 million. That is all loans put together is 100 million. What you will do is, you will move it to an SPV because these are assets. You are issuing a security that is backed by these assets. It is called as asset-backed security. Asset-backed security. Why? Why did the name come? Because you are pooling multiple assets, creating a security by securitizing all of those and issuing securities. And what are you doing? You are not issuing single security. You are issuing multiple securities. Now, what is this confusion? Let us see. You are pooling them in an SPV and issuing 3 securities. 100 million principal issued in 3 parts. What are these 3 parts? You have something called as a senior tranche, which is 80 million, where you get LIBOR plus 60 basis points. Now, this 100 million on an average basis, let us say they were earning LIBOR plus 300 bips. Okay. All these assets together, let us assume that their average return over whatever period, assume all of them are same 1 year loans, all of them put together is 100 million, the weighted average rate is LIBOR plus 300 basis points. I am just making up a number, okay. I don't know how the numbers will work, we will see. You split it into 3 parts. What are these 3 parts? You call something called as a senior tranche. Then you call something called as a mezzanine tranche. Mezzanine means something in between. If I don't know if you have heard, there is something called as a mezzanine floor. A floor between ground floor and first floor is called mezzanine floor. Okay, then you have something called as equity tranche. What do these words mean to you? Senior tranche. Senior is typically used in terms of debt. So, it is debt, meaning there is 100% payment. Then you have mezzanine. Mezzanine is between equity and debt. It is not neither ground floor nor first floor, middle floor. It is between equity and debt. Then you have equity. Equity means what? Equity is equity, full risk, risk on, 100% risk on. Whereas in senior tranche, only some element of credit risk exists, whereas in equity tranche, the business risk also exists. Now you see, I'll clean this up. Equity tranche is only 5 million and LIBOR plus 200 basis points. Mezzanine tranche is 15 million, LIBOR plus 250 basis points. Senior tranche is 80 million, LIBOR plus 60 basis points. What is this? You have 80 at L plus 60. You have 15 at L plus how much? 250. L plus 250. You have 5 at L plus 2000. What does all of this work out to? If you multiply all of this, you get 100 on this side, and here do 0.8 into 0.6, that is better. 0.8 into 0.6 is equal to 0.48 plus 0.15 into 2.5 is 0.375 and 0.05, which is basically this 5 million, into 20 is 1. So you add all this, you get 100 million of LIBOR plus 1.855. LIBOR plus 1.855, which is LIBOR plus 185.5. So now I change this number. Let us say all these loans are weighted averages LIBOR plus 150 bips. But you have now a bip is 1/100th of a percentage. So 185 bips is 1.85%. So 1855 is 1.855%, right? 0.48 plus 0.375 plus 1. Yeah, correct. Right. So you have various assets which are at LIBOR, weighted average rate is LIBOR plus 150 bips. You have parceled them out, you have split them into 3 parts. Equity tranche, mezzanine tranche, senior tranche, and each one has a different rate. Why each one has a different rate? Because each one has a different risk. How is the risk different? You see here, you see this next one. Waterfall of an asset-backed security. What happens in an asset-backed security? When all these cash flows come, these top cash flows, right? These are 3 assets. When all these cash flows come, they come here. They go into a pipe called ABS, which is basically this SPV. And first, the money is paid to the senior tranche. That is, whatever return is there, the return, LIBOR plus 60 basis points is paid off to the senior tranche. Then, whatever is left out, some drops come in, they are paid to the mezzanine tranche, which is how much? LIBOR plus 15 basis points. LIBOR plus 250 basis points, which is only 15 million. Then finally equity tranche is paid. But equity tranche, you see here the money that is going to them, and here what am I referring to? Asset cash flows, not the interest. See, interest is serviced for all. But if any asset goes bad, out of all these assets, even any asset goes bad, the first hit is for the equity tranche, because equity tranche guys are repaid last. This is here the pipe and this waterfall, everything is for the asset repayments, not for the interest. Interest also there is a logic, we will come to that. But first, if at all somebody defaults, the default is first taken off against the equity fellow. So if let's say out of this 100 million, 1 million default is there. What will they do? This 100 million, 80, 15 and 5. So default 1 million. This 1 million is adjusted against the equity fellow and he gets only 4 million. Now the total amount, the total outstanding is 4, 5 and 80. Another 2 million default happens. So this becomes 80, 15 and this is 4, no? 4 minus 2 is 2. So equity tranche keeps getting reduced and the interest of LIBOR plus 2000 bips. 2000 bips is what? 20 percentage points. 2000 bips on, LIBOR plus 20 percentage points. That is paid to equity guy because they are taking higher risk. Whereas this fellow, after the entire equity is wiped out, the debt mezzanine fellow takes the hit. After the mezzanine fellow, everything is wiped out, then the senior tranche takes the hit. So, from a risk perspective, see this logic. Risk and return are directly correlated. As the risk increases from here, the return is also increasing. That is, you are getting LIBOR plus 2000, LIBOR plus 250, LIBOR plus 60. Now, in all these assets, what is the possibility that more than 20% of the assets have gone bad? Very, very unlikely. Bank NPAs are 2%, 3%, 5%, 6% like that. No bank runs a loan book which has 20% NPA, unless of course it is Yes Bank or somebody. right? So only when such kind of high quality, only when such kind of high losses are incurred will the debt guy, the first guy, senior tranche guy, lose out. Now I'm calling it as debt, but it is actually called as a senior tranche. So these securities which are issued, these three, they are not known as equity, debt and mezzanine, equity and debt. They are known as ABS, asset-backed securities, senior tranche, asset-backed securities, mezzanine tranche, asset-backed securities, equity tranche. Each of them has a different value. The total value of each tranche is different. The interest rate on each tranche is different. The risk taken by each tranche is different. And the payments that come, or the short payments or the defaults that come, affect each one of them independently. This is an asset-backed security. This is an asset-backed security. We will discuss about mortgage-backed security, 2008 crisis, all of that. I will come to that later. But first you have to understand asset-backed securities. Okay, we have discussed about credit link note and we have discussed about asset-backed securities. Okay, then we will go to CDO. But before that, let me take you through what is an MBS and then 2008 crisis. 2008 crisis I think we can discuss later, but what is an MBS? Okay. Now friends, what are mortgage-backed securities? Very, very simple, nothing complicated. In this image or in this chart what you have seen here, I have told each one is an asset. Asset could be multiple varieties of loans. It's a mortgage loan. A mortgage means housing loan or a loan for property. It can be housing, it can be normal commercial also. So, if all these assets, instead of being a varieties of loans, are only mortgage loans, mortgage of house property, mortgage of commercial real estate or anything like that, then it is called a mortgage-backed security. You again issue all these securities like this, that is called as a mortgage-backed security. A security, which is issued, which has multiple tranches like this, which is issued, but it is backed by mortgages, that is housing mortgage or your commercial mortgage, that is called as a mortgage-backed security. Very, very simple. Why is mortgage-backed security important and why is it relevant to 2008 financial crisis? We will understand when we understand what is a CDO. Now comes the question what basically they have explained in our institute material as CDO. Okay, I will first go through what is given in the institute material. I have made some minor changes. It is not 100% easy to understand, so I am actually explaining it in a much more easier manner. But what is there in the material and what I am explaining, both are same. Logically, theoretically they are same, but they have explained it in a very confusing manner. I am simplifying it. What are CDO? Let us see. A CDO is an ABS. Okay. Issued by a special purpose vehicle. The SPV is a business entity or trust formed specifically to issue that collateralized debt obligation. A CDO consists of a pool of debt such as auto loans, home loans, mortgage loan and other ABS. Okay. It is a way of creating securities with widely different risk characteristics from a portfolio of debt instruments. A CDO, which is basically an ABS CDO. And please note my friends, all these diagrams I have actually taken from John C. Hull book. Okay, the book which I keep saying, derivatives ke liye, the God, the Bhagavad Gita of derivatives is your John C. Hull. Okay, so ABS CDO is basically, a CDO is a mixture of varieties of assets. So you have a variety of assets here, right? One of the assets is an ABS. So I'll explain again. CDO or rather ulta. You have assets. This can be home loan, commercial loan, credit card loan, student loan. All these put together, you form something called as an ABS. Only home loans or only commercial loans, you do something called as MBS. CDO is varieties of assets plus an ABS, including an ABS. It can be multiple assets, but necessarily has to have ABS, or it can be only ABS, or only ABS, or only MBS, or a mixture of both. So the idea is a CDO is a second order integration of cash flows. What do I mean by that? What is this first order integration? First order integration, you have various assets, you are pulling them into an SPV and splitting the cash flows such a way that based on the equity tranche guy will actually take the biggest hit on any defaults. You have mezzanine tranche guy and you have a senior tranche guy. Now, if you take a mezzanine tranche and put that as part of a CDO, so you take the mezzanine tranche here or mezzanine tranche here or mezzanine, or you take the equity tranche or you take the debt tranche of an ABS and add it as part of assets and again collateralize, again securitize it and create another structure, that is a CDO. It is a second order integration of cash flows, right? So, which is exactly what caused the crisis. You see, there are variety of assets. These assets have senior tranche, mezzanine tranche, equity tranche. All these mezzanine tranches, you combine multiple mezzanine tranches of multiple ABS or multiple MBS and then package them and create another security which is called CDO, which has a senior tranche, mezzanine tranche, equity tranche. So, you have multiple loans. From those loans, you create an ABS. You have multiple ABS. From those ABS mezzanine tranche, you create another something called as CDO. So, you are basically doing second order derivative. So, what happens is, in the original loan, some small thing happens. The entire pack of cards falls. Original loan, original what? Student loan, that home loan, car loan, all those loans comes to an ABS. ABS has a mezzanine tranche which is mildly risky. All mezzanine tranches put together becomes CDO. Original loan, something happens, the higher order effect on this end goal, right, end product is very, very high. This is exactly what caused the subprime crisis. Let us further read. Okay, so a CDO consists of pool of debt such as auto loans, home loans, mortgage loan and other APS. It is a way of creating securities with widely, but actually it is also widely different risk characteristics from portfolio of debt instruments. So, you are creating a new instrument from other instrument that is created from another instrument. Okay, and what are the various types of CDOs? Okay, before I go to the CDO types, let me explain the subprime crisis. I am oversimplifying it. Okay, please don't take this as some written truth. I am oversimplifying purposely so that it is easy to understand. What happens is, you have housing loans, then you have these MBS. From this MBS, you have a CDO and a CMO. CDO is debt obligation, collateralized mortgage obligation. CDO is collateralized debt obligation, collateralized mortgage obligation. So ABS and MBS. Using these housing loans and variety of other assets, you create these two. Using these, you create these. Now, you have housing loans, car loans, student loans, all this. So, all these move like this move like this. Each one has a different thing. Okay, only housing and real estate is MBS, only mortgage is CMO, whereas all other types plus ABS is basically a CDO. Okay, please remember the distinction. What happened is, these housing loans, US was at a historically low interest rates in 2008. They were running in very, very low interest rates for tens of years. So, everybody thought interest rates are not going to go up. And when interest rates are not going to go up, you will watch this in that movie Big Shot. Interest rates are not going to go up. People thought we are permanently in a no risk zone, no risk. So, for people who are not eligible for a housing loan because who don't have money, who don't have a good credit score, which is subprime mortgages. Subprime, prime means good, subprime means below good, which is basically poor. They were given lot of subprime mortgage happened, and the US housing rates were always going up. The house prices were always going up. So, what people did was, they were lending money to subprime borrowers, basically people who are not creditworthy borrowers, at very low interest rates, assuming that the housing prices will never fall down, they will only go up. Even this credit unworthy people default, we always have the house which we can sell off and make our money. And those loans, subprime loans, repackaged into MBS, which were repackaged into again CMO, CDO and all that, and these started trading in the market. And all of these had AAA, AA, fancy ratings. Credit ratings were also equally culpable. You package it so many times and you complicate it, nobody knows what is going on, what shit is there inside, nobody knows. And they started packaging it and they started selling this. Now this is like a pack of cards, right? I purposely am drawing like this, okay? There is a huge pack of cards. You know what a pack of cards, right? Playing cards. You put bottom and then you build a pack of cards. If this one collapses, if this one collapses, the entire card comes falling. So what happened was, this went on and on and on. That is, giving loans, repackaging them, selling them as CDO, CLO, getting the money, using again that to give more loans. So it became a nightmare. And once somebody started shorting all these CDO, CMO, because they knew that this is a pack of cards. So Michael Burry, that was one of the guys whom you see in the movie, is a doctor actually, MD doctor, not a MBBS kind of thing. He did MD and then he got into investments. He and a lot of other people also, they basically shorted all of this. They said that this is unsustainable because the underlying asset, which is the subprime mortgage, is gone. I mean, you have lent to all credit unworthy people and they're not repaying on time, you're lent it at a very low rate, and the housing market you're thinking is going up. One day when this particular, there's a term called shit hits the fan. One day when something goes wrong, you will see that everything comes falling and all the CDO, CMO, everything will be worthless. So a lot of people, including Goldman, Deutsche, Lehman, CT, Merrill Lynch, BofA, multiple such banks started, there were various desks in those banks. So a lot of those desks who were dealing in the CDO, CMO were going aggressively and buying. But there were some smart people who at the back were shorting all this. They were aggressively shorting all of this because they knew that the underlying loans were not creditworthy enough. And one day when the housing prices don't go up, or one day when some small thing happens which will trigger a domino effect, which will have a domino effect, whole entire risk will come down crashing. Right? This house of cards will come down crashing. So CDO, CMO, these are the culprits which cause the crisis. Why? Because, and as Warren Buffett says, we will read this subsequently also, this is like a financial weapon of mass destruction, because they completely ruined the market. And Lehman Brothers went down because they were overexposed to this entire market. They had a huge, they had built so many CDO, CMO and multiple other structures in ABS, MBS, that they were overexposed and none of the loans that were supposed to pay were paid off. So the entire market collapsed, and Goldman that time survived. And they made money because apparently a lot of traders in Goldman also made this mistake. But at the senior level, the CEO level, the chief risk officer and the CFO, they knew what was going on. So, and a very small group of people started shorting this. They started buying credit default swaps and they started, shorting all these things so that if ever there is a risk, when this whole pack of cards fall, they will make money. They shorted tens of billions of dollars of worth of, these securities. Or rather they took, default protection against all these securities, and Goldman made billions of dollars. This is the story. And who all lost? A lot of people lost. Because why? The house prices, which are always supposed to go up, came down. When house prices come down and these people have, whoever are subprime borrowers couldn't repay the loan or couldn't pay the interest or whatever, they said, you take the house, I don't want the house. So when people started like that giving back the houses, there was suddenly an increase in supply of houses. So what happens when there is an increase in supply? The price falls. When the price falls, what will happen? Domino effect. Nobody is repaying, prices are falling, all the loans crashed. And the CDO, CMO structure completely came down crashing. And whoever had bought credit default swap on specific instruments, right? So there are again government issued instruments like Fannie and all of that. I will not get into all of that. There are separate corporations of US corporations which basically have this housing instruments, housing market related instruments. So Michael Burry, he basically bought credit default swap against those, and he made tons of money. So this is the core of why the 2008 subprime crisis happened, because you had these mortgage loans which were repackaged, on which second order, third order derivatives were made. Those derivatives were highly oversensitive to any small change, and that small change did happen and the entire derivative market collapsed. Okay, now after having understood this, now you will look at CDO in a very, very different manner. What are various types of CDOs? There are various types of CDOs which are, first one is called cash collateralized debt obligations, then you have synthetic collateralized debt obligations, then you have, in synthetic you have unfunded, fully funded, partially funded, and you have arbitrage CDOs. We will basically be discussing these three. Fully funded, cash collateral, first one is cash flow collateral, then you have synthetic collateral, then you have in synthetic unfunded, fully funded, partially funded, then you have something called as arbitrage. Okay. Now, first let us understand what is a cash collateralized debt obligation, cash flow collateralized debt obligations, which is what I explained to you here in the above diagram, which is cash CDO is a CDO which is backed by cash market debt security which normally have low risk weight. This structure mainly relies on the collateral risk weight and collateral's ability to generate sufficient cash to pay off the securities issued by SPV. So, what happens is, all the securities when they are issued, the money comes in, the money is basically kept as collateral in one, government securities. You keep the money in some very, very low risk securities. So, basically you are not using the money. You basically have an asset, that from that asset you issue ABS, from this ABS you again take out multiple tranches, and from the mezzanine tranche and other assets you create a CDO. And the money that you get from the CDO, you basically keep it in, very, very low risk securities, basically government securities. This is a cash flow collateralized debt obligation. Very, very simple. Now, what is a synthetic collateralized debt obligation? It is similar to cash flow. This is where the story changes. This is what caused all the nightmare. It is similar to cash flow, but the difference that instead of transferring ownership of collateral to the SPV, synthetic CDOs are structured in such a manner that credit risk is transferred by the originator without actual transfer of asset. Okay. Normally, the structure resembles hedge funds, wherein value of portfolio of CDOs depend upon the value of collateral instruments, and the market value of CDO depends on the portfolio manager's ability to generate adequate cash and meeting the cash flow obligations, principal interest in a timely manner. What is this confusion? Okay, we will read a couple of more paragraphs and then I'll come back. While in cash CDO, the collateral assets are moved away from balance sheet, in synthetic CDO, there is no actual transfer of assets. Instead, economic effect is transferred. This effect of transfer of economic risk is achieved by creating provisions of CDS or by issue of CLN in form of liability. Accordingly, this structure is mainly used to hedge the risk rather than balance sheet funding. Further, for banks, the structure also allows the customer relations to be unaffected. This was started mainly by banks who wanted to hedge the credit risk but not interested in taking administrative burden of sale of assets through securitization. Technically speaking, synthetic CDO obtain regulatory capital relief vis-a-vis cash CDOs. Further, they are more popular in European market due to the reason of less legal documentation, and they can be categorized as follows. We will come to categorization later. What happens in a synthetic CDO is, it is similar to cash flow CDO, but difference that instead of transferring ownership to a separate entity, they are structured in such a manner that credit risk is transferred by the originator without actual transfer. So, you are basically transferring the risk without transferring the assets. Whatever money is received, where is that? There is the other word. Normally, structure resembles hedge funds where value of portfolio of CDOs depend on the value of collateralized instruments, and the market value of CDO depends on portfolio manager's ability to generate cash. Now, this is irrelevant. This we will come back later. While in cash CDO, collateral assets are moved away from balance sheets, in synthetic CDO, there is no actual transfer of assets. So, in a cash CDO, you are moving the assets away and you are getting some money, you are putting it in government securities. Whereas in a synthetic CDO, you are not moving the assets. You are not creating. So, SPV does not have the assets, but it has issued securities. Think of it that way, no? In a synthetic CDO, the SPV does not have the original assets. It is issuing the securities. In cash CDO, collateral assets are moved from balance sheet. The original assets, the loans, all of those are moved away from balance sheet. In synthetic CDO, no actual transfer of assets. Instead, economic effect is only transferred. How do you just transfer an economic effect? By issuing by creating provision for CDS or by issuing credit linked note. So, basically, you issue a credit linked note. Okay, instead of transferring the loans, you issue only a credit linked note. On the back of the credit linked note, multiple CLNs, you create an ABS. From the ABS, you create an CDO. Wow, what a complicated structure. That is exactly what is the root cause of all of this. You created only the economic effect of a specific loan. You took it out instead of transferring the loan, and that economic effect alone is basically again split into parts, and all such multiple parts of multiple such economic loans are again merged together and a CDO is created. Such a complicated, such a unnecessarily complication, third order, second order thinking, right? The effect of transfer of economic risk is achieved by creating provision for CDS or by issue of credit linked notes. So basically, you are either transferring the entire risk by issuing credit linked notes, and from that credit linked note you create new ABS. From that you create basically a CDO structure. Accordingly, this structure is mainly used to hedge the risk rather than balancing funding. Further, for banks, the structure allows the customer relations to be unaffected. Why will this allow the customer relations to be unaffected? So, because when you create a proper cash back, a cash flow based CDO, you actually inform the customer saying, we have collateralized it, this is moved on and on and on and so forth. Whereas here, you are just created a credit linked note and sold that off. That's all. This is why understanding what a CLN is, what an ABS is, what a MBS is relevant for you to understand what a CDO is. Okay. Coming back. Further, the structure allows customer relations to be unaffected. It was started mainly by banks to hedge the credit risk, but not interested in taking administrative burden of sale of assets. Correct. They didn't want to do all that activity. A credit linked note is what? It is simple transfer of a loan. But here, you transfer a loan and of one party, of one corporate, but we are integrating multiple such transfers, creating multiple securities, then packaging that security into one more security, which is again repackaged. All these loans get into ABS, all these ABS get into a CDO, which again CDO has multiple tranches. Technically speaking, synthetic CDOs obtain regulatory capital relief vis-a-vis cash CDOs. Further, they are more popular in Europe than because of less legal documentation. Now come back. What is the other paragraph? Normally, structures resemble the hedge fund, wherein the value of the portfolio of CDOs depend on the value of collateralized instruments, and market value of CDO depends on the portfolio manager's ability to generate adequate cash in meeting the cash flow obligations. So what happens in a hedge fund is, hedge funds typically have some money, they over leverage. They leverage 5 times, 10 times and all that. There are people who give them money, okay. They use that leverage, or basically they use that money to enter into derivative transactions. So when I say leverage, what it means is, I explained this concept when I was talking about that MTM concept and all of that, where I very, very specifically said concept of leverage with respect to derivatives is very, very different, which is, you have 10 rupees, you buy a stock. You can buy a stock for 10 rupees, but you have 10 rupees. Let's say the stock is worth 1000 rupees. You can't buy the stock, but you can buy an option on this 10 rupees, a 10 rupees option on this 1000 rupees stock. If this 1000 rupees stock moves to 1200, by investing 10 rupees, you have got 200 rupees. Same way with futures. In futures, you put 7%, 8%, 9% margin on a stock of 1000 rupees. The stock moves to 1200, this entire 200 is yours, mine, and the margin whatever you've got, your only investment on this 1000 rupees is only this 7%, which is 70 rupees. By investing 70, you got 200. So if there is a sharp move, you are basically gaining money. However, if there is a loss, if this 1000 moves to 800, you have to now pay, instead of this 7% margin, you have to fund the loss, the 200, and then you have to keep 7% margin, which is 70. So you basically have lost 270. So on a 70 rupees investment, it is possible you can lose 200. On a 70 rupees investment, it is possible you can make 200. Now, why is all of this relevant in this particular context? Hedge funds operate like that. Hedge funds, they raise some money from HNIs, play in derivatives, buy options, sell options, enter into futures market, where they have to keep only a small percentage of capital and may make large percentage of gain in value. Like hedge funds, these CDO structures also, because they are synthetic. So when we wear clothes, cotton is natural cloth. Synthetic clothes are rayon, nylon, polyester and all of that, right? So this synthetic structure is similar to hedge funds because you are basically trying to leverage. So you take a mezzanine of all mezzanine tranches, you integrate and create another tranche of which there is a mezzanine tranche, of which there is an equity tranche, of which there is a senior tranche. So you are playing on one mezzanine tranche which is linked to multiple mezzanine tranches which are linked to multiple underlying assets. So basically you are levered up. So if there is a gain, you will make spectacular gain. If there is a loss, you will make a spectacular loss. Okay. The idea is, whenever you create such securities, you have to also service those securities. For you to service, you need to generate money which you can use, basically that principal and interest which has to come from original borrowing. You receive that and then you service your eventual investors in CDOs. If they miss, your equity tranche guy of the CDO loses the money. Okay, they've explained it in a complicated manner. I've tried to simplify it by saying that there is a lot of jargon in this, ignore the jargon. The idea is you're creating a CDO by integrating multiple ABS. Okay. Now, in synthetic CDO, there are there are three things: unfunded, fully funded, partially funded. What is unfunded? You will only have a CDS. So, you are issuing a CDO, but how are you transferring the risk? By, it is comprised only of a CDS. That is, you are basically using a CDS to transfer the risk. You are issuing a security. What security? Equity tranche, mezzanine tranche, and then you have the senior tranche. But you have to pay all of them. How are you paying all of them? By writing CDS. By writing CDS, you are getting premium. Using the premium, you are servicing all of these. So it is unfunded. You don't have underlying assets. It is completely unfunded. It is synthetic. It is artificially created. But how are you going to service? You are servicing it by writing CDS. You are servicing it by writing CDS. In fully funded, it will be through credit link notes. That is, you basically, instead of writing CDS, you actually purchase some credit link notes, wherein you are taking the credit risk, but you also have an underlying loan which you have purchased. Please note this distinction. When you are writing a CDS, you are taking the credit risk, but without a loan. When you are taking a CLN, when you are buying a CLN, credit link note, you have completely the loan also, and you also have the credit risk. So you actually have cash flows. Partially funded is mix of CLN and CDS. So you have a mix of both wherein you partially fund. So basically you have created artificial security without actually having underlying cash flows. Cash flow linked CDO is where you actually have cash flows. Unsynthetic is where you have three types. Unfunded, where you don't have cash flows but use writing CDS to generate premium, use the premium to basically pay off all these various tranches. Credit linked note is where you actually, which is fully funded, where you actually have using the money that is given to you by various tranche holders, you put that money, take that money and purchase a credit linked note. Whereas in case of CDS, what do? You get the money from all these people, you invest it somewhere, use that money for trading and use that money as collateral to write CDS, and from that CDS, whatever money comes, you use that to repay all these tranches. And partially funded is mix of both. What is an arbitrage CDO? Basically, in arbitrage CDO, the issuer captures the spread between the return realized collateral underlying the CDO and the cost of borrowing to purchase these collaterals. In addition to this, the issuer also collects fee for management of CDO. This arbitrage arises due to acquisition of relatively high yielding securities with large spread from open market. So, what happens in an arbitrage CDO? Arbitrage means what? In two markets where there is a difference, where in one market it is cheaper, one market is costlier, you try and make money. In an arbitrage CDO, the goal is you basically use, you issue a CDO, there are three tranches, equity, mezzanine and senior. You get this money is invested in GSEC. I'll call it GSEC instead of treasury bills or US securities, I'll call it just as GSEC. And then you also issue, let's say, a CDS, you write a CDS, so you get premium. Okay, you get a return from this and you get a premium. These two you combine and you pay these people. Okay, the return that you get from here and the return that you get from here, you combine and pay them. Now, what typically happens is, and again you have to see the return of these two is LIBOR plus 150, everything put together here is LIBOR plus 160 or something like that. So, the weighted average return here is 150, 160. So, now here what you do is, you try and get securities here. Let's read the exact words that have been used here. Issuer captures spread between the return realized from the collateral underlying the CDO and the cost of borrowing to purchase this collateral. So, what you realize here, you probably try and pay these guys only 10%, whereas you earn 15% here. Or you pay them LIBOR plus, here this is ulta, it should not be 150, this is 160. I think I made ulta, this should be 150, this should be 160. You are earning 160, you are paying 150, you are keeping money 10 bips with you. Same way, you are earning 15% and you are paying them only 10%. You try and find out securities which could be risky, riskless, whatever. You try and find out securities where you pay them a lower amount, whereas you get a higher earning from them. How is it possible? Only when you have high risk securities. So let us see. In addition to this, issuer also collects fee from management of CDO. So basically, for managing this whole thing also, you collect some money from all these people. So that's how you make money, right? This arbitrage arises due to acquisition of high yielding securities with large spreads from open market. So what are high yielding securities? Basically junk, basically poor quality debt. Instead of investing in safe assets, you go and invest in risky assets where there is large spreads. So you basically earn high interest in that. You buy them at a low rate and get a high spread and get a high interest rate and then pass on, whereas to these people you give basically a low return. So you say that I've invested it in A quality assets or AAA quality, whereas you invest in mix of AAA, AA, B and all of that. You pay them AAA return which is 8%, but you earn here 8%, here 9%, here 11%. You keep this 11, difference between 11 and 8, you keep with you. So basically it is honestly if you ask me, some sort of structure where you are trying to generate an alpha by taking additional risk which is not warranted. You may disclose everything to them, but then you are taking, first of all, a CDO is a double derivative, 2-order leverage. On top of that, you are doing like this. It is recipe for disaster, which is what happened in 2008. Okay. So, in an arbitrage CEO, the issuer captures the spread between the return realized from the collateral underlying the CDO and the cost of borrowing to purchase this collateral. In addition to this, you collect fees, and arbitrage arises due to acquisition of high yielding assets with large spread from open market.